It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks gain, kicking off a week set to be dominated by data, including the Fed's preferred inflation indicator. Also ahead, G7 finance chiefs blast Beijing's trade practices, threatening tougher protections for the economies and critical industries. Plus, India's Modi government has bared its legacy on a $534 billion infrastructure boom. We get a view on how things have changed on the ground from logistics firm Allcargo. First off, let's get to markets. Avril Hong on top of that, and Avril, just like that, we have risk sentiment rebounding.
Yeah, that is spurring what we're seeing among Asian equities. This is a tracking of Wall Street's performance last week. And thanks to that renewed optimism about the Fed's rate path, that consumer inflation expectations paring back, maybe we could see some room for cuts this year. So stocks are gaining ground, but some risks to watch out for. Remember, at the end of the week, towards the end of the week, we're going to get the Fed's preferred gauge of inflation. And while it is expected to show moderation, as our MLive colleagues have been pointing out, this is likely to have been driven by those volatile airfares. So might not spark much confidence from the Fed. Don't forget, we also have some Fed speakers due. Based on the schedule, it looks like the Hawks might get more airtime than the Doves. But as you said, just like that, Asian equities catching that bid, TAIEX leading gains, Kospi also doing quite well. CSI 300, Hang Seng pretty flat. They're coming off a week where those property support measures, the skepticism whether it is going to be enough, really weighed on sentiment. Throw in as well the Taiwan Strait tension. Among currencies, we're seeing that recovery in the yuan as well as the yen, but can't say the same for Japan's 10-year bonds that continued selling, the expectation of the BOJ's policy normalization. But I guess to your point about how we are going to be data focused this week, let's flip the board, take a look at what we're seeing out of China. Industrial profits rose, and that is against the backdrop of exports having returned to growth. Domestic demand also seems to be improving. So some signs of that recovery, Has.
That's right. Lots of data to digest. Avril Hong, thank you. Now, here's a look at some of the top economic news we're watching out for this week. Of course, front and center, U.S. core PCE deflated. Now, this is going to be a key indicator for the U.S., of course, on the back of uncertainty remaining over when the Fed will start cutting rates. Financial markets remain convinced, and easing is coming. A slew of data in Japan, and Tokyo inflation set to climb back up. Production likely rose. Unemployment rate probably fell. The overall picture set to boost the BOJ's confidence it can go ahead with more rate hikes. And of course, China's PMI survey expected on May 31st. Recent data has painted a pretty mixed picture of China's economy, suggesting the recovery remains fragile. It remains pretty uneven. Now, let's get more insight with Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital. Shane, good to have you with us. Lots to digest, but front and center, the PCE, which will be crucial for the week, you think?
I think it probably will be. And of course, for us in the Asian time zone, it will come after our markets have closed because it comes out on Friday nights. But those numbers are going to be looked at pretty closely. There is a good chance there that the core PCE, that is, if you exclude food and energy, will come in at 0.2%, probably a high 0.2%. By that, I mean 0.24. But if that is the case, it knocks the annual rate down to 2.7%. It also has the effect of dropping us out of the range that it's been in, the 0.3% or so range that it's been in for the last few months. So that would certainly be good news. But obviously, we've got a fair way to go yet. 1 month's worth of lower inflation numbers is not enough. It wants to see the Fed wants to see a run of weaker inflation numbers before they can cut interest rates.
Does it essentially change anything, though, Shane? We've already gone from 6 cuts for the year to perhaps 1 or 2. What's your own, and what are you expecting?
Well, I think the reality is, if you go back earlier this year when the market was expecting 6, I think at one stage it was 7. The expectation was that that would start around March, believe it or not. And of course, we've now gone through that. September and July look very, very unlikely. Sorry, June and July look very unlikely. So there's not a lot of meetings left by the time you get to September. So I think the odds are, unless the economy slides into recession with very much weaker inflation numbers, will only end up with about 2 cuts this year, probably in September, maybe another one and one more before we get to Christmas. But I don't think those PCE numbers will change anything except add to confidence that we will get those cuts and that they will start in September rather than a little bit later.
Well, the thing is, risk appetite has not really been dented all that much. We talk about how risk sentiment has returned today. The thing is, when do you see higher for longer really impacting sentiment, or might it not at all?
Well, it may not at all. I think what's happened this year is that, yes, we've seen a wind back in those interest rate cut expectations and a delay in their timing, but the markets have said, oh, it doesn't matter, we've got stronger profit numbers. So therefore, somewhat bad news on interest rates has been replaced by better news on profits, and that's kept markets going. So as long as you get some combination of that sort of mix going forward, then high for longer interest rates is not a major problem for the market. The problem would arise, of course, if we get much weaker economic data and the inflation numbers stay somewhat elevated. That sort of leads to that talk of stagflation. If you get that, that would be bad news for markets. I think the more likely scenario is that we get some softer inflation numbers. Markets like that. And then, of course, the next issue would be, well, is economic growth going to be too weak going into the end of this year and 2025? Which would then start to turn the story around again, because you go from Goldilocks, not too hot, not too cold, to the risk that you might have a recession. And obviously that hasn't been much of a concern in the last few months.
So, Shane, when it comes to bond yields, are they trending higher?
They may in the short term, but I think the more likely scenario is that they will head down through the remainder of this year and going into next year, mainly because we are going to see somewhat slower inflation numbers. That will confirm the likelihood that the Fed will cut interest rates, starting in September, 2 cuts this year, a little bit more next year. And we'll probably also see some weaker economic growth. We're already starting to see signs of that. The March quarter GDP numbers in the US came at 1.6%. I think we do get an update on that this week. That might be revised down to 1.3% or something thereabouts. But I think that slower growth and slower inflation will enable bond yields to drift lower. Now, of course, there is uncertainty around the US election, which I guess is a separate issue, but a Trump victory could be more inflationary. But that, I guess, is still several months away yet, not till November, before we know the outcome of that.
Shane, the big debate right now is neutral rate. Where is neutral and what's driving it?
Well, that's an academic question. It's a bit like, where is the NAIRU, the so-called natural rate of unemployment? But I would think for the US, it's probably not 2.5%. It's one of those stars, R star, a bit like the U star, the natural unemployment rate. But of course, it is all in the stars. Economists will have multiple different views on this. I suspect that it's probably a little bit higher than the Fed's 2.5%, which from memory is their latest long-term rate projection for the Fed funds rate, probably a little bit higher than that. I think we do have to allow that we have come into a world which is somewhat more inflation prone than what we had 5 years ago prior to the pandemic. These policies of deglobalization, protectionism, very low unemployment, bigger government, more subsidies, more regulation, all those sorts of things make the world somewhat more inflation prone. Now, of course, artificial intelligence could go in the opposite direction, but there's a lot of forces sort of lined up against that. So I suspect the neutral rate is probably a little bit higher than 2.5%, but it's really hard to work out how much higher it is.
Shane, given the assumptions that you've just made in this conversation, how should your portfolio be looking like right now?
Well, I think you probably have a bit of a growth bias. I think there is still more upside in share markets. So I'd have a slight overweight to share markets. I don't want to have a big overweight because we have had big runs in markets from their bear market lows back in 2022, October 2022. And we've certainly had a big run up since the correction last October. So, we are going to get some volatility. It's going to be a more constrained ride than what we've seen. It's going to be a more volatile ride. And I think that's just evidence. We've seen that over the last few weeks, over the last month or so. It's going to be a rougher ride, but I think the broad trend remains up. So that's why you'd still want to have some overweight growth assets like shares. And I'd probably have a neutral to slightly long duration position in bonds because, as I mentioned, ultimately, I think bond yields will go down.
All right, Shane, hang tight. Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital. He'll be sticking around. Well, still ahead this hour, our exclusive interview with one of India's largest publicly owned logistics companies, Allcargo. We'll discuss their outlook for global trade and why they're bullish on growth for the second half of the year. Keep it here with us. This is Bloomberg. Welcome back. China, Japan and South Korea have held a rare trilateral leaders meeting today in Seoul. Xinhua's reporting the Chinese Premier Li Qiang is stressing that ties among China, Japan and South Korea are unchanged. For more, let's bring in our Chief North Asia correspondent, Stephen Angle. And Steve, we know that this trilateral meeting was supposed to happen more often, but it took a break of almost 5 years. So this is significant.
It is significant. This is an opportunity for China to improve relations with, of course, two of its closest strategic neighbors, South Korea and Japan, and not necessarily with the United States at the table either. So this is really evident in the readout of some of Li Qiang, the Chinese premier's comments, as broadcast through Xinhua or printed via Xinhua. Premier Li urging Japan and South Korea to uphold free trade, to oppose playing camp politics. That's basically a reference to the United States, and also urging Japan and South Korea to uphold the spirit of autonomy. And China also urging cooperation resumption with those two countries. And then again, we've also been hearing as these three gentlemen, including Kishida, you just saw there from Japan, and President Yoon of South Korea, both are making a few comments. President Yoon saying China, Japan, South Korea seek transparent supply chains. Kishida also focused on people's exchanges between Japan and visa-free travel between Japan and China and cooperation with ASEAN. And also, Kishida said he expressed desire to exchange views on a free trade agreement. That's been long stalled and full of tough issues, obviously. And Beijing clearly would like to court Japan and South Korea to not necessarily go full headlong along with the United States in its export controls on advanced semiconductors and chip-making equipment, and that those export bans. Japan has signed off on similar kind of restrictions last year, but has not gone further despite U.S. pressure to do so. So there's so much to talk about, mostly economic low-hanging fruit. The geopolitical issues obviously are going to be not solved in a single-day trilateral agreement. But not surprisingly, South Korean President Yoon and Kishida of Japan have both talked about the threat that is posed by North Korea and any potential threatened new missile tests that are possibly forthcoming out of Pyongyang.
You talk about tough issues, Steve. I mean, China again in the line of fire, this time at the G7. Finance ministers had some strong words about China's trade policies. What did they say?
Well, this is interesting as well because, again, the G7 finance ministers have probably taken the most assertive approach towards addressing what they claim to be overcapacity and some subsidies by the Chinese and distorting global trade, an existential threat to exporting nations like Germany, which has a strong, of course, industrial base. So essentially the G7 providing a unified voice to counter some of their concerns. They they have over China's trade policies. Again, this was supposed to be a meeting that really focused heavily, and it did, on basically engineering a way to fund the defense of the Ukraine, perhaps using the investment returns off seized money from Russia. And that is, they have moved the ball forward on that, and perhaps there could be a communique that comes out of that, a resolution, a unified voice from the G7 at the leaders meeting later this year, actually in July in southern Italy. But for this time, on the shores of that lake in Italy, they talked very squarely about the threat that is coming from China and the potential dumping in various advanced economies around the world because of their overcapacity.
And as if all the tension's not enough, Steve, a U.S. congressional delegation has arrived in Taiwan. Clearly, this will upset Beijing.
Yeah, and it came pretty quick, the trip after the inauguration. We were over there in Taiwan for the inauguration of Lai Ching-te just a week ago. And, of course, subsequently after that inauguration, we saw a fairly surprising, well, if you think about the history of the PLA exercises, they're not necessarily surprising, but we didn't know it was going to come so quickly. So we saw, of course, about 111 military aircraft from China fly various sorties over 2 days of exercises around Taiwan. Dozens of PLA naval ships also encircled Taiwan. The U.S. government has called this a military provocation and voiced their concern. Beijing, for their response, saying this was intended to serve as a strong punishment for the separatist acts of Taiwan independence forces. Now, of course, this is a high-level delegation of U.S. representatives from Congress, including the Republican from Texas, the House Foreign Affairs Committee Chairman Michael McCaul, and other members of Congress. It also coincides with Jensen Huang, completely separate trips coming to Taiwan as well, ahead of the big Computex on June, I think, 4th to the 7th. Some of the biggest names in the tech world will be coming to Taiwan over the next couple of weeks for that Computex. Could be the biggest ever.
And we await China's response. Stephen Angle, thank you. Now let's bring back Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital. Shane, I mean, we have rising tensions all over Asia, all over the world, in fact, and we have potential flashpoints. Yet here we are with the stock market edging higher and higher, pretty much risk appetite intact. Is the market underpricing risk?
I think to some degree it is, and it does worry me that investor confidence is actually so high on many measures. And if you look at the VIX index, or the so-called fear index, it's actually very, very low, suggesting there is a degree of complacency there. That said, I can understand why investors have been somewhat complacent, and it's because even though we have these geopolitical flashpoints, and we've had them for some time now, the disaster scenarios, or the scenarios which would be bad for investment markets, haven't really come to pass. Yes, we're seeing issues around Taiwan, but it's not full-out war. It's just the same thing that's been going on and off for many, many years. Yes, we're seeing war in the Middle East, but it's not actually disrupting the flow of oil to the global economy. Yes, we're seeing trade disruptions through the Red Sea, but trade is still occurring. So yes, these things are negative at the margin, but they're not enough to cause major disruption. So I think that's why markets are not so focused on them. But the fact that you've got relatively high levels of sentiment, very, very low levels for the VIX, tells you that, you know, there's not a lot of, not a big buffer there. If anything goes wrong and one of these tensions do flare up, then obviously share markets would be vulnerable. But trying to time that, I think, is going to be really, really hard, as it has been for many, many years. You're often better waiting for the event to occur, if it does occur, and then respond, because the odds are you'll probably get the timing wrong.
The added risk from geopolitical tensions, would that perhaps deter you from being attracted to Chinese stocks, even though we've seen some recovery there?
Well, not necessarily. I mean, it is a risk factor, and it does raise longer-term questions, but I don't think they're necessarily significant in the short term, to the extent that it should dissuade an investor. If you look at forward price earnings multiples across Asia, the market darling, of course, has been India, but it's trading on something like 23 times, which is actually very, very high. The Asian average is about 13 times. In China, it's 10 to 12, depending on which share index you look at, H shares or shares listed in mainland China. So there is value there in Chinese shares. And if we can see some pickup in stimulus activity, we're starting to see some. We've seen the biggest property stimulus move a week ago. Then that could be a positive factor for the Chinese share market at a time when the Indian share market at the other extreme is looking a little bit toppy, or at least looks like it might go through a period of consolidation.
Shane, we had El Arian weighing in saying that, the spillover from geopolitical risks could be far and wide across all asset classes. How do you protect yourself against such risk? What's the best play?
Well, that's a good question. Trying to predict that, I think, is going to be really, really hard. You could have said that 1 year ago. You could have said that 2 years ago. Every time these events come along, markets go in a bit of a spin and then say, oh, well, OK, let's move on. We saw that in 2022 with Ukraine, and the war is still continuing. So we saw that in October 2023 in relation to the war in the Middle East as it flared up again. But obviously, if you do get a serious flare-up, adversely affecting global activity, particular oil supplies, then you'd want to have some hedges. Gold is a potential hedge there. You could potentially consider buying VIX as a potential hedge. Got to be a little bit careful there because that is an extremely volatile asset class. And you might want to have some defensive shares, particularly as we go into, not so much just yet. I mean, the seasonal pattern often sees strength into July. But as we go through the months of August, September, I suspect that's where there is going to be a bit of vulnerability, particularly ahead of the US election. And so that's where you might want to have a somewhat more defensive portfolio through that period.
Shane, great insights. Thank you. Shane Oliver, Head of Investment Strategy and Chief Economist at AMP Capital. Plenty more ahead. Keep it here with us. This is Bloomberg. A pretty good day for Taiwan. The TAIEX at a record high, rising as much as 1.3% earlier, boosted pretty much by AI-related stocks such as NVIDIA boss Jensen Huang landing in Taipei on Sunday to attend to a tech expo, as we heard from Steve slightly earlier. MediaTek, which is reported to be developing an AI PC chip with NVIDIA, surging as much as 9.6%. Foxconn Technology currently up by 10% as we speak. We're also tracking China e-commerce stocks rising after the government vowed support. Because of that, we're seeing the likes of global top e-commerce jumping almost 10%. Sale event times also surging more than 10 right now. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to lunch. The CSI 300 index currently up by 0.3%. Investors pretty much shrugging off the possibility of that spillover from trade tensions on the back of the G7 meeting. Of course, we also have the U.S. reimposing tariffs on hundreds of goods imported from China, all part of a broader plan to increase duties in strategic sectors. Take a look at that CSI 300 index up 0.4%. In terms of the yuan, 724.50 is the level we're looking at, flat versus the USD. It is a strong, or rather weaker, dollar story today. And when it comes to global funds, they're only cautiously adding to their holdings in Chinese stocks. Now, as China heads to lunch, Japan is back from lunch break. Avril Hong on top of developments. there.
We're tracking Japanese equities, mostly moving higher in line with their other Asian counterparts, but they are underperforming. If you take a look at how the Kospi or the ASX 200 are faring, slight gains. The topics is led by the climb in Toyota. We're seeing the dollar yen hovering still at that 157 level, a bit of a recovery. This is a story of a softer dollar. And what I really wanted to talk to you about in Japan are the bond moves. Let's flip the board and take you there as we have those continued expectations, perhaps ramped up a little bit, that the BOJ will start accelerating its normalization of policy, perhaps faster than previously thought. And on that note, we did get towards the end of last week, remember, the BOJ governor saying that on those long end yields, despite them hovering at their 12-year highs, he doesn't seem to think that's an issue. He says this should be guided by the market. Still, they did touch on this earlier today as well in his speech, and he said that the move would be cautious in terms of re-anchoring those inflation expectations. Let's flip the board, because as you see here, there's a lot of pressure on Japanese bonds, and that's despite what we saw in their US counterparts. Remember, they caught a bid last Friday. Bond futures are also pointing to some upside at the start of the next cash trade session, and this is, of course, against the backdrop of that renewed optimism, what we're going to get from the Federal Reserve. But put this in context, Treasury markets have really been upended this year amid that repositioning of what the Fed's going to do, Haas.
That's right. Who knows what the Fed's going to do? Well, Avril Hung, thank you. Bond traders who are stuck in a waiting game of a Fed policy may soon get some welcome support. The U.S. Treasury Department is preparing to launch a series of buybacks while the central bank begins to taper the pace of its balance sheet runoff. Bloomberg M Live executive editor Mark Cudmore joins us for more. First off, let's start with Fed speak. They're likely to be cautious, hawkish.
Yeah, I think they're going to be hawkish this week. And I think some of the fundamental issues there of slowing down the QT process and the fact that we're doing specific buybacks for the first time in about 20 years, I think they're kind of well-flagged, structural. I think the backdrop of this week is actually yields to continue to kind of nudge higher again. The narrative that we're adjusting to is the fact that, hey, inflation's still sticky, financial conditions are super loose. There's no real justification for central banks, most central banks in the world, to be easing aggressively just yet. ECB will probably get away with one because they've so pre-committed to it and it makes more sense. But I just still don't see how the Fed can be discussing rate cuts anytime soon.
But we just had a conversation with Shane Oliver, who says yields are likely to trend low. I mean, what are the chances he could be right?
I mean, obviously, that's been the narrative for the last while, that yields will ultimately trend lower. And sure, the consensus out there is the next move is lower for yields. Absolutely. The idea of rate hikes has been flirted with occasionally, but rapidly dismissed. So I don't think many people are thinking that way. So that's a very consensus view. The likelihood the consensus is right, you'd say is got to be high. It's the consensus. I'm actually saying that the consensus here is being overestimating the probability, and that there's an underestimated risk that, in fact, yields aren't trending lower from here, which has just been the assumption for so long.
And this QT, where are we with that?
Well, obviously, we're going to slow the pace, and that's going to help, and that's going to ease some of the stress here. And actually, I think the Fed has managed that very well so far. And I don't think that's a real big dynamic. That's a real big problem. But I think the fundamental drivers here are what level of interest rate policy is adequate for this economy. And this is an economy that is still holding up well. Growth is still strong. Markets are performing really well, and financial conditions are super loose. So it's an economy which is sending a message going, hey, monetary policy does not appear too tight. If anything, if you look at markets, if you look at inflation, you look at financial conditions, it says monetary policy is too loose. That would indicate yield should be higher.
Yeah, that's right? We hear from the Fed saying that policy is restrictive. The question is whether it is restrictive enough, given where inflation is right now. Might we hear a different narrative from here?
I think they're going to be slow to change the rhetoric, in terms that the reaction function of the Fed will remain very dovish. So what they're trying to be very clear about is, we'll cut as soon as we get an excuse to cut. And that's what they've been very clear since the December Fed and that thing. The problem is they have no excuse to cut right now. It's arguable that Fed policy is restrictive. maybe. It might be restrictive. It doesn't seem like it. There's not much sign for it right now. It is true there's long and variable lags. We like using this phrase lots in recent years, and therefore the restriction of policy over the last couple of years might still be to impact, and that is definitely true to some extent. But there's no real sign it is actually restrictive at the moment, which is why there's a chance the Fed has to hike again.
Fed is data dependent. Other central banks are now data dependent too, and we have a lot of data coming out this week. How do we make sense of it? How is it likely to play out in the markets?
This data dependence thing is a bit of a weird phrase because, of course, central banks have always been data dependent. They've never moved away from that. I think what they got into a dangerous world of giving too much forward guidance and then backing themselves into a corner, like nearly pre-committing to policy. And they started using this phrase data dependence recently to kind of say, hey, we're not that pre-committed. They're just trying to give themselves more optionality. There's been no real change though. The Fed has always wanted to be data dependent. Now there's two aspects. There's the data that comes in, and then there's the policymakers' reaction function to that data. So what we have at the moment is a Fed which has an extremely dovish reaction function. However, they're still going to react to the data. So if the data gives them an excuse to cut, they will cut. If the data is kind of neutral or anything but enforcing hikes, they will not hike. But ultimately, it's those two inputs, data and then the reaction function.
And Japan?
Japan, I think, ultimately will hike rates by more than's been priced in the market. We have the story overnight saying it might be at 0.5% by the end of the year. I think, of course, it should be. I think that should be the base case above there. I actually think that it might be, several hikes. And I don't think it's going to change things massively in Japan. I think what we've realized is that, this is a country that needs to normalize policy. It'll benefit the economy over the long run.
And the yen?
I'm still bearish the yen. I mean, at some point, look, I've been bearish the yen for 3 years most of that time. I still remain bearish the yen. I think that, don't confuse a yen view with dollar yen. There's a dollar component, but I think yen is absolutely one of the worst currencies in the world on crosses. And it's, deeply negative real yields, not a great economy. It's a commodity importer in rising commodities world until the BOJ significantly changes policy, which may happen later this year, but I'm not saying it yet. Until they significantly change policy, I'm not just taking a hike or two, then the yen will remain bearish on crosses.
All right, Mark, great stuff. MLive Executive Editor Mark Cutmore. Still ahead, Indian logistics company Allcargo says it expects green shoots of growth for its international supply chain business in the second half of the year. We'll find out why. The Chief Strategy Officer will be joining us for an exclusive interview. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus. India starts trading in about 6 minutes from here, and futures pointing to a higher open, pretty much in line with the rest of the region. Sensex index up 0.3%. Of course, it is a booming market, but some say at risk of a sell-off should Modi's party win a slimmer majority in the polls. No signs of that just yet. Right now, we have gains in terms of the Nifty futures, currently up about 0.1%. Well, for more on the growing market concern as voting draws to a close, let's bring in Asia Equities reporter Ashutosh Joshi. Ashutosh, what are the latest expectations for markets?
Hi. The 10 years of Prime Minister Modi's administration have been extremely fruitful for markets. India has seen growing its share of not only emerging market investments, but globally the heft of India or Indian stock markets has gone up. India is now world's 5th biggest in terms of market capitalization and very close to hitting a $5 trillion mark in terms of its market value. That means there are hopes that the same policy will continue with Modi in administration returning for the 3rd term. But at the same time, there is a worry that if the alliance led by Prime Minister Modi or his party fails to win less than expected seats, or it ends up winning lesser seats that initially expected, that may lead to some sort of correction in markets. And that is something visible in a gauge of fear, VIX index, which is highlighting. The volatility in Indian markets has gone up in recent months, and at the same time we are seeing some selling by foreign investors.
And of course, the elections coming amid searing temperatures in India, that's helping to lift some stocks. What do we know? What are the details?
Yeah, peak summer months in India are turning unbearable. There is some parts of India have already crossed 50 degrees Celsius temperature, that is close to the record levels. While it's difficult to manage heat, a segment of markets, makers of companies that have their products aimed at summer sales, products such as beverage makers or cooling equipment makers have benefited because of additional demand. We have seen the earnings forecast for these companies have risen more than the market in recent weeks, thanks to the demand their products get during the peak summer months, and these stocks have rallied.
Ashutosh, thank you so much for that. Asia Equities reporter Ashutosh Joshi. Now let's stay with India. Allcargo Logistics reported its fourth quarter results over the weekend, including a 6% revenue increase from the previous quarter. The company says it expects growth for its international supply chain businesses in the second half of 2024. Ravi Jakar, Chief Strategy Officer at Allcargo Group, joins us now. Ravi, good to have you with us. Well, how much clarity do you have in the coming quarters? Can you do better?
Yeah, so if you look at all the businesses, I think we are quite optimistic. Starting with the smallest of the three businesses, contract logistics, that's been a stable business. It's a business which is, irrespective of the good or bad macroeconomic conditions, works on long contracts and has been very stable and continues to be that way. If you look at the second business, which is our express business under Gati, in that business, we had been working on a lot of initiatives, and in the quarter gone by, we have seen significant cost improvements. As an outcome of that, our gross profit went up by 15%, and our EBITDA went up by 115% in the express business quarter 3 versus quarter 4. And this is despite the fact that a large part of that cost improvement happened sequentially from January until March, which means that the exit is much better. So considering this, we believe that the gross profit margins would continue to remain much healthier in the coming quarters, and Gati Express business should do well. The largest business, which is under AQ Worldwide, our flagship international supply chain business. As you know, in that business, we have recently seen a pickup in demand. We have been maintaining this, that we expect the demand to be bullish in the second half of the year. And now we've started seeing some green shoots. A couple of months ago, people were booking cargo about a week in advance, but now it's almost like a month in advance, which means that we have visibility of cargo sailing end of June, which will be delivered in July. And I can tell you that on many trade lanes, the freight rates have gone up by as much as 4 to 5 times. $2,000 freight from Asia into Latin America is now touching $7,000. And it's a factor of demand, which is what we believe that should help us increase the volumes and should also help us improve the margins as we go further.
Ravi, you talk about cost. How is that playing out for you in a strong dollar environment? I know that you have operations in 180 countries. We have the rupee trading, hovering at record lows, close to record lows versus the USD. How is cost playing out for you?
So most of our international business is transacted in US dollars, which means that we are buying freight in US dollars and we are also selling most of the international revenue in dollars. So therefore, it's a natural hedge for dollar that plays out. There are some costs which are staff costs, etc., which play out locally. But there's a natural hedge, I will say, on an overall basis. And therefore, our performance is not really subject to volatilities in US dollar in that sense.
We know that you embarked on a restructuring plan that went on for about 3 to 4 years. How is that playing out for you? And are you already benefiting from that?
That's played out very well for the company, the management, and the shareholders. 2 businesses that demerged last year are doing very well, Allcargo Terminals and Trans-India Real Estate. And now the final leg of restructuring is underway. We expect early next year for Gati and EQ Worldwide also to become separate listed entities. And from a management perspective, they're already distinct, sharp business focus. And I think it's worked out very well. And as we reach the final stage, it should be very good for all stakeholders.
Which will be the game-changing division for Allcargo, you think?
I think the way we are positioned in our LCL trade globally, it's a unique blend of, large-scale physical infrastructure with market dominance and a significant lead on technological advancements. And a combination of them is so unique in a very interesting market on the back of e-commerce and MSME growth in global trade. I'm very bullish about the international supply chain business. And back home in India, the way the economy is bound to grow, and we are, of course, everybody is looking at the election results, but it's unlikely to see some surprises. The Indian economic growth story is likely to continue, and that means great opportunities for express business, which thrives on consumption and manufacturing-led demand. And we believe that in India, in the next 10 years, you will see both manufacturing and consumption to grow significantly. So these two businesses, which are part of Allcargo Logistics today, I think both have tailwinds from a mid-term perspective, and we are very hopeful about these two.
Ravi, Allcargo acquired Fair Trade recently. How is that working out?
So we acquired about 75%, last year, and then we acquired the balance 25%, considering the macroeconomic environments prevailing in the last few quarters. So we were also able to renegotiate some terms, and therefore the payouts have been lesser. So it's been a good time to kind of advance the transaction and helped us, improve the transaction economics. Now in Germany, we have one competitor less, and that opens up the opportunities in one of the largest markets in the world. So in a way, with this acquisition, with the restructuring, I think everything is coming out quite well for us. As this is also a special year for us. We are celebrating 30 years of Allcargo Logistics this year. And I think everything is falling in place for creating the platform for long-term growth for us across the domestic as well as the international business. So very happy with that.
Given that everything is falling in place, is there reason to think that you'll be in a position to make more acquisitions?
I don't think we need any further acquisitions at this point in time. We are very well placed. We have all the geographies covered. Whatever missing pieces were there, we have taken care of them. And we have been able to attract the best talent. Like I said, we are very uniquely positioned in the international trade as well as domestically. And we have been able to attract the top talent from the industry, and we would continue to do so. We would look at building stronger commercial teams across the world wherever we see an opportunity. And at this point in time, we do not see any need for acquisitions. We can grow organically very well. Particularly with the macroeconomic conditions rebounding, we should have a very good second half of the year, as I see it.
Ravi, thank you so much for that. Ravi Jakar, Chief Strategy Officer at Allcargo
Always a pleasure.
Group in our
Thank you.
exclusive interview there. And another story we're following out of India. Asia's richest man, Mukesh Ambani, is setting his sights on Africa with a new telecoms venture. A unit of Ambani's Reliance Industries will provide key network infrastructure, applications and smartphones for Ghana-based NextGen Infraco. The company is planning to provide 5G broadband services to mobile operators and ISPs by the end of this year. Well, India's been trading for about 4 minutes now. Let's do a check on how the benchmarks are doing. In the green at this point in time, in the money. Sensex index up 0.3%. Indian rupee trading at 83.1050, flat versus the USD. Well, still ahead, minority investors of Singaporean insurer Great Eastern pushing back against OCBC's takeover bid for the company. Hear why they think the billion-dollar offer is still too low. Keep it here with us. This is Bloomberg. We're taking you back to the Lion City. A group of minority holders of insurer Great Eastern are resisting a billion-dollar takeover bid from OCBC. For more, senior Asia finance reporter Chanyapon Chanjaron joins us here in Singapore. Chanya, good to have you with us. Obviously, they say it's too cheap. It is at a 30% discount. What is fair value then?
Well, to be fair to OCBC, the offer price is close to 40% premium of the stock price before the announcement was made on May 10th. So in terms of price, it looks very high. But shareholders of Great Eastern are arguing that in terms of the embedded value metrics, which is a common insurance firm gauge in valuation, they argue that the current offer is at 30% discount to the embedded value. So we still have time to see whether other shareholders disagree with this group. Yeah, because Great Eastern just appointed Ernst & Young as independent financial advisor, and EY will make recommendation to shareholders. They still have time to think about it.
They still have time, but do they have options?
Well, that depends on OCBC. The company also has time to, there's some chance that many analysts think that OCBC may up the ante a little bit, but the threshold to cross for takeover is quite low for OCBC because the company already owns more than 88% of Great Eastern. Once OCBC acquired up to 90%, there's a chance that the share will get suspended, and we can go from there.
You got to wonder how this might play out.
Yes, it is a very big takeover deal that we should watch over the next few months.
So how might this play out? What are some of the things that you're watching out for?
Well, we will have to look at the time when the physical offer is dispatched to shareholders and see the number of shareholders, how many of them will accept the price. So we will watch after 90% threshold is crossed. That's a very significant point to check.
What does it mean for OCBC shares in the coming months, you think? How might that play out?
That's a very good question, Haslinda. The OCBC has been beneficial from, has get lots of benefits from Great Eastern in terms of earnings accrual. Whether to take 90% or 100% of Great Eastern, I think in terms of earnings, there's maybe not much to think about, but currently we have two boards, OCBC board, Great Eastern board, although OCBC is the majority shareholder. So some analysts argue that it would be easier for the management if Great Eastern is delisted.
All right, $1 billion deal. That's not enough. Our senior Asia finance reporter, Chanyapon Chanjaran here with her take on it. In the markets, let's take a look at how we're doing. It is an update for Asia. Investors back batting on that rate cut to be made by the Fed this year. The MSCI Asia Pac Index up about 0.5% after suffering its worst week in more than a month. Sentiment back being driven by expectations on the Fed. Of course, Paul Krugman says he's highly uncertain about the rate path. He sees confusion, delusion over rates. Talk about being on the other side of the coin. We're keeping an eye on utility stocks, tech, which are leading the gains at this point in time. China, of course, the one that we're watching, it is U.S. reimposing tariffs on hundreds of goods imported from China. That may just weigh on sentiment. On balance, though, it is an up day for Asia. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.